Hey everyone, Brian Hayes here with Zacks Investment Research. It's an exciting time in the stock market right now, with the major US indexes nearing their former all-time highs. Just yesterday, the widely followed NASDAQ 100 ETF, or the triple Qs, closed at a fresh all-time high. So I thought it'd be a good time to talk a bit about what led us here and also take a peek into one of the portfolios that I manage here at Zacks. Now, I manage two portfolios. One is an income based strategy that is tailored toward investing in companies with a history of raising dividends. And the other is a more growth oriented portfolio that focuses on companies with positive new events that we call our headline trader portfolio. So, whether that be new products or services, changes in company management, or things like earnings or revenue surprises, positive guidance, along with other innovations. And we see this type of news a lot in the markets, right? A company introduces, for example, a new product, and this type of headline news can cause a repricing of the stock, propelling a surge of optimism within the market and subsequent price appreciation. So today I'm going to focus on the latter portfolio, which again is growth oriented. And you might be thinking to yourself, a growth portfolio, how can that be low risk? Growth stocks are inherently more risky, right? And to a degree that is certainly true. But there are other methods we can employ to decrease our overall risk levels and put the odds back in our favor. And today I'm going to peel back the curtain a bit and dive into some of these methods that have enabled our subscribers to achieve a 127% average return with 100% open trade winners. So make sure to stick with me to the end, where I'll reveal a stock I'm targeting right now that's on my watch list, one that I believe has the potential to be a triple-digit winner over the next year. But I wanted to start today with a look back at the first half of this year. There were two so-called shocks to the market, and the first was the trade war sparked by President Trump's tariff agenda. At the onset, we heard a lot about Canada and Mexico, who are two of our biggest trading partners, but over time, the focus really narrowed to China, and we ended up with 145% tariffs really out of the gate. So as we know, many U.S. companies derive a significant percentage of their revenues from China, and the S&P 500 earns 4 times more selling to China than the U.S. loses in trade deficits. That's 1.2 trillion in annual revenue versus about a $295 billion trade gap. So the idea of decoupling wasn't just political. It's an asymmetric risk to S&P 500 earnings. So let's take a look at the S&P 500 earlier this year. And this is what the chart looked like. This is a big deal. And it was really the uncertainty surrounding the whole situation. Was this going to be a 2-month thing? Was this going to drag out for 2 years? Does it escalate further? The markets went into full-on panic mode. Prices of stocks fell, and participants began to price in potential outcomes that no one thought even possible just a few short weeks prior. And as we moved on, after all the uncertainty, we've now come to a place where both sides, the US and China, seem willing to cooperate, which is a big positive. We've seen substantial progress, a big de-escalation with drastically reduced tariffs, which happened much more quickly than I think most people thought, including myself. So this is another big positive, a win-win for both sides. And it really goes to the root of what was the cause of this nasty correction earlier in the year, which was the uncertainty surrounding tariffs. And it's this shift as the market has gained more clarity when things resolve, and this shift that can really kickstart great opportunities. So to me, this really looks like we've entered the next phase of this new bull market. We had the initial rally off the April lows based off positioning and short covering. We've entered the phase where the core problem of the correction in the S&P 500, and it was actually a bear market, in the NASDAQ is now becoming resolved. And along with that, we have some strong tailwinds, including the AI boom and in related investments. We went from seemingly negative headwinds earlier in this year, several of them, to potentially several positive tailwinds, including a Fed that should become more accommodative with recent inflation data coming in light. Now, the other shock that came recently to the markets was in the form of the Israel-Iran conflict. And we certainly don't want to minimize these types of conflicts in any way, shape, or form. But from an investment standpoint, it's important to keep things in perspective. How have markets responded in the past to significant geopolitical and historical events? We looked back at nearly 40 such events, and on average, 3 months following the onset of the event, stocks were slightly higher. So we can see here an excerpt of this study covering events over the last 12 years. And generally speaking, these events can spark heightened volatility in the near term, but eventually, as we see, stocks tend to bounce back fairly quickly. So as serious as this escalation and the prospect of war are, prior instances have shown us that developments may not have much of an impact on U.S. economic fundamentals or corporate profits. And note that the larger negative figures in this image also coincided with bear markets, such as the March 2020 COVID-19 plunge or the inflation-induced bear market of 2022. Now, of course, we cannot dismiss the risk that the latest conflict may escalate further, but the stock market's track record of recovering quickly from these events can at the very least provide a sense of reassurance to investors. Now, in this day and age, it really pays to turn off the news. The stock market is an enigma. One of the best descriptions of the market I've ever come across is the great humiliator. It wants to humiliate me, you, and as many people as possible for as much money as possible and as long as possible. Our goal is to engage the market while not letting it humiliate us and to generate an acceptable rate of return in relation to a given level of risk. And everyone's risk level is different. Different investors have different types of risk tolerances. Today, the market's best tactic is to scare us from the coming rebound. Now, investors nearly always doubt new bull markets, often for years after they begin. They frequently wonder, how can we possibly be in a bullish period when everything is so bad out there? And oftentimes things are bad. But stocks don't necessarily move higher just because things are improving. In some cases they do, but rather they climb because everyone's expecting the worst. So the Israel-Iran conflict is just the latest example. It's really another reminder among the countless historical cases to trade the market's reaction and to turn off the news. It's clear that the market's trend remains up and we need to be aligned with it. The market is telling us to expect positive outcomes in the future with regards to a resolution to recent conflicts, the tariff and trade wars, along with U.S. fundamentals and corporate earnings. So that's a bit of a recap on the first half of the year. Now let's take a peek into one of the portfolios I manage here at Zacks. So I've been trading for more than 20 years now. And in the beginning, I made just about every mistake one could make. And through that journey, I've developed a process to identify winning stocks. It's rigorous analysis that employs a combination of fundamental and technical analysis that seeks to pinpoint stocks that are primed to enter a period of outperformance. So here we can see a snapshot of the headline trader open portfolio. The stocks themselves have been removed to protect our current subscribers. And notice that we are relatively diversified. We're a bit overweighted tech, which I think is warranted in this environment, but we have exposure to other sectors, including financials and healthcare. We're spread across industry groups, and I've harped on this over the years, as our current subscribers know, that we typically target stocks within leading industry groups. because quantitative research studies have repeatedly shown that a stock's industry group plays a rather large role in its future performance. We can see an average weighted return of over 127% with 100% open trade winners, so all of our trades are profitable. So how do we go about identifying these leading companies and stocks? How do we narrow down the entire investment universe, the thousands and thousands of stocks out there, to the ones with the best profit potential? The first step that I implement is to determine the underlying trend. We want to target stocks that are either beginning or already in established uptrends. Now, we've all heard the sayings, the trend is your friend, trade with the trend, but I can't stress or emphasize enough how important it is to our success. The best way to determine the trend, in my opinion, is to measure the extent of buying and selling pressure. So let's take a look at one of the systems I use to do this. There are hundreds of indicators available to help us determine the trend, but in my experience, a winning system doesn't need to be complicated. In fact, I found that the more complicated a system is, the less likely it is to work in the future. I use a few simple trend following systems to help me identify the trend, and I found one of the best and most reliable systems, and one that I use every day, is the 10-month simple moving average. So to illustrate here, we have a chart of the S&P 500. This is a monthly chart, and when the stock, ETF, or index in this case is trading above the 10-month simple moving average, the security is on a buy signal, and when the security trades below the moving average line, a sell signal is issued. So here we can see back in early 2022, the S&P 500 kissed the moving average line, which actually acted as support for a while, but ultimately fell below it, issuing a sell signal. Traders following this system would have saved themselves a lot of headache during the nasty 2022 bear market that followed. Then in early 2023, this system went back long stocks after it crossed above the 10-month moving average, signaling that stocks should be bought. And later that year, in the fall of 2023, notice how the moving average line acted as support when the market corrected. Now, we spent the entire year of 2024 above the moving average line. We dipped back below it temporarily with the correction earlier this year, but we have this snapback look and are now back at new monthly highs on the S&P 500, telling us that more strength is likely in store. So this is a very simple but effective system that can help us determine when we want to be long or short stocks. So at any given time, there could be hundreds or even thousands of stocks on a technical buy signal. And one of the ways we further narrow down our list is through the Zacks Rank system. Corporate earnings are one of the main drivers of stock market activity over time. And that's why earnings expectations and estimates are so important. And it's the change in earnings estimates, called earnings estimate revisions, that our research has shown to be the most powerful force impacting stock prices. Once we've identified and confirmed a stock's trend, the Zacks Rank system helps us narrow down the investment universe to stocks that are experiencing positive earnings estimate revisions. So these revisions lie at the heart of the Zacks Rank, which classifies stocks into one of 5 categories, ranging from strong buy to strong sell. Stocks with rising earnings estimates have significantly outperformed the S&P 500 over time, and we want to target companies for which analysts are revising their estimates higher. Only the best stocks garner a Zacks Rank number 1 strong buy or number 2 buy. Now, these ratings can and do change based on a number of factors, one of which is the magnitude or the size of the recent change in the consensus earnings estimate for the current fiscal year as well as the next fiscal year. Let's take a look at a highly ranked stock that I'm targeting for entry in the near future using a combination of the Zacks Rank system as well as the trend following system we discussed. Astero Labs currently meets our criteria. The stock did rise above its 10-month simple moving average in May, and this company designs and manufactures semiconductor-based connectivity solutions for cloud and AI infrastructure. we can see that ALAB is a Zacks Rank number 2 buy. The stock IPO'd last year and has surpassed earnings estimates every quarter since. They've delivered a trailing 4-quarter average earnings surprise of 28.41%. And Astero is part of the Zacks internet software industry, which ranks in the top 21% out of all Zacks ranked industries. So this company is meeting our criteria. It's checking a lot of boxes. Analysts covering Astero are mainly in agreement, as we can see, in terms of revisions, and have been increasing their earnings estimates across the board. We can see full-year earnings estimates have risen by 7.14% to $1.35 per share. How does that compare to last year? Very favorably. That translates to growth of over 60% relative to last year, 77% higher revenues. So these are the types of trends that we want to look for when narrowing down our list of potential stocks. Remember, this is just a small portion of our stock selection process, and I'll end today's video with an important reminder. The S&P 500 has been in 11 bull markets, not including the current one, since 1949. So for those of you that may feel like you missed the boat on this latest rally, remember, bull markets have lasted more than 5 years on average, and some have gone on much longer. The S&P 500 hit a new high in January of 2024 following the 2022 bear market, and dating back to the 1950s, once those former highs were put into the rearview mirror, bull markets lasted an average of another 4.5 years. So this overlooked fact suggests the potential for more gains ahead that could be substantial. Investors normally underestimate the length and magnitude of bull markets, so make sure to stay engaged, take advantage of everything that we offer here at Zacks. That's it for now. From all of us here at Zacks, thank you for watching. Hope you enjoyed this content, and we'll see you next time.